Thomas here. We're going to kick it off with interest rates. A year ago in November, the US Treasury, the 10-year Treasury, and I use the US 10-year Treasury as the benchmark because it is the real indicator of what's kind of going on in our marketplace here in North America, especially and Europe. So it's the gauge in my mind. So here we go. A year ago, the 10-year Treasury was 3.2%. In other words, if you lent your money to the US government for 10 years, you could lock in a 3.2% interest rate. In August, that fell to 1.47. So it was cut more than half in terms, and that's in less than a year, cut more than half in terms of what you would be paid for lending your money. Right now, we're sitting in at 1.68. And so, interest rates have been extremely volatile. Alongside of that has been the inverted yield curve. And so in August, we also had an inversion. And what does that mean? Well, what it means is that the 2-year Treasury, so the US 2-year interest rate, actually was earning higher return than the 10-year Treasury. And it wasn't so much that the 2-year had gone up, it's that the 10-year came down so dramatically. Typically, when we have a yield curve inversion, as it's referred to, a recession is going to follow. It's been predictable over the last 5 recessions that that would be the outcome. The last one, of course, was in 2008. The yield curve inverted, though, in July of '07. And it took all the way through till, 14 months later, roughly, that we had the full blowout of the financial crisis. And so with a yield curve inversion, the recession may take anywhere up to 18 months to follow. Of course, going back to '08, in '09, March of '09, we hit the bottom in the markets and the economy, and things started to turn around. And the central banks, mainly the Federal Reserve in the US, began to print money, like unbelievable amounts of printing money. Ben Bernanke was the Fed Reserve. He was known as Helicopter Ben, because basically he was going out just throwing money into the marketplace. The challenge I see from that is that we've had so much inflation, and by inflation, I mean so much printing of money, so much interest rate manipulation, that this time is the yield curve inversion actually a true indicator of an upcoming recession, because we haven't been allowing the marketplace to freely determine what rates might look like. We've been based on printing of money, interest rate manipulation. And so it's really hard to know what that inversion really meant. And I've been reading and going through a lot of different analyst reports, and I'm not getting a clear indication from either side as to what that looks like. So what would I say going forward? It is critical here to make sure you understand how your portfolio is invested, have some cash reserves, especially for if there is a downturn, it's opportunity, right? While others are fearful, we want to be greedy, as Warren Buffett would say. So take the opportunity in a downturn to add great quality investments into your portfolio. So in order to do that, have some cash, definitely have some short-term fixed income in your portfolio, and then you can have some market exposure. But I would be, for myself personally, I'd be lighter in that front. I know inside my insurance policies right now, I'm yielding just over 5% in safe money. So that stuff to me is the golden safety, really, in terms of my cash. So that takes care of interest rates. Let's talk about how the markets have done. So the TSX for our Canadian investors, the TSX in the last 6 months is up 2.9%. That's right here till the end of September 30th. The S&P 500, on the other hand, is up 4.04%. And again, for Canadian clients, depending on whether that's in US dollars or Canadian dollars, the fluctuation of the currency will determine whether you've done better than 4% or less than 4%. Gold. So back in the spring, we were talking about precious metals. Again, we talked about it in the summer report, and gold in the last 6 months is up 13%, and silver is up 11.8%. So what does that tell me? That tells me that a lot of money was looking for some safety, especially when we got into all the trade talks, all the rhetoric between the US and China around trade. We saw a lot of volatility in the markets. We saw the markets sell off. We saw interest rates kind of go up and then come down. And in that in that time frame, a lot of money was going into precious metals because they're viewed as a safety net. Even Ray Dalio, one of the owner of Bridgewater, the largest hedge fund manager in the world, we're talking, well over $500 billion, actually came out with an article that gold would be a good thing to have in a portfolio. And so I know that helped to drive up the price of gold as well. Today, as I record this, gold has had a negative day today because everybody's feeling a little better about the U.S. and China, and some good news came out around their trade talks. The big winner in that time frame has been Bitcoin. It's up 50% in Canadian dollars over the last 6 months. I'm not advocating that you rush out and buy a whole bunch of Bitcoin. Just saying it's up 50% for those people that are interested in cryptocurrency. And I guess the question I have, and where I am within in thinking about this for myself, is that, is cryptocurrency going to become a version of gold? In other words, a safety net. I don't know that we're there yet. There's a lot of people on the crypto side that say yes. And then there's a lot of people on the other side of the camp that are really skeptical, that say it's a scam. So right now, I'd say cautionary, cautionary, cautionary on crypto. Having said that, it looks like Bloom, an update here, a little quick update for Bloom, will be moving forward with a partner where our clients, if they want a trusted source in order to buy some crypto, take a little dip into the cryptocurrency world, we're going to have a link coming out soon on our platform that will allow people to safely own some cryptocurrency that is protected as well. And so this is a Canadian company that's coming out with this. It's from a friend of mine that I worked with a long time at the Chamber of Commerce. He's reached out to me. He's been working with this company for a while now, and it looks like we might have a platform where clients will be able to take a little dip into the crypto world. Let's update on AIP and WealthSimple for our clients. So WealthSimple, again, is our robo advisor, if you will, where we can assist clients to own electronically traded funds. So ETFs, it's an ETF portfolio. So if that's of interest to you, it's very low cost. We do have the ability to offer that to our clients. And then we have our partner AIP. And I think it's critical to point out here that year to date, to the end of August, the AIP limited partnership, so their hedge fund, has actually done 11.3% return this year. And I see, my talks with Jay and the folks at AIP are something like this. I see what they do in terms of managing, adding their hedge fund in to a really safe mix of fixed income and ETF strategies. The idea here is to build the best return possible with the lowest amount of risk. And ultimately, as an investor, that is the goal that we all are aspiring to. I want to get the best return with the lowest possible risk to losing money. And certainly the AIP hedge fund blended into a portfolio certainly adds that element where you can get the upside of the hedge fund and use a lot of safe style investments on the other side. And in that, you get low volatility, you get low risk, and you still get really good return. In the investment space, we call that alpha. What is the manager doing to increase your return and also limit the downside? Because ultimately, when the bad days come, we want to lose less, and when the good days are there, we want to make as much as we can. Oh, last thing, here we go. Profit First. Bloom Living Podcast, brand new show coming October 1st with the writer and owner of The Profit First, Mike Michalowicz. It's a New York Times bestseller. I have become a Profit First professional. So here at Bloom Strategies, we mandate this way of thinking at Profit First. This is great for business owners, entrepreneurs, where we can go in, look at your business, and build it to be a profitable first company. I did all of this work on Bloom Strategies. I went through the training and used my own business as the first test. And now we've adopted some of our clients' businesses already into Profit First. We're working with them on building a Profit First enterprise. It's the same thing to me, the same insight that I had when I read The Wealthy Barber 20 years ago and got into this industry. It is about paying yourself first. And I would say that you could take this methodology, you could take the Wealthy Barber methodology, mix them all together, and use that not only for a business owner, but for your personal finances. This is the work that needs to be done on the personal side as well. Knowing where your money's going, understanding your cash flows is critical to financial success. And the great thing is at Bloom Strategies, that's what we're here to do. This is what our service really is all about. This is how we want to serve people going forward, is working with them to get an understanding of their money and how they can best use it for what they want to accomplish in the world. And so I encourage you, set up a 20-minute call with me. Let's have a discussion on where we can best serve you going forward and see what's possible. If you want to review your portfolios with AIP, let us know. We can help to arrange that. If you want to review your portfolios with Wealthsimple, let me know or let us know. We can help to arrange that as well. All right. Have a great day. And that's it.